Silver just dropped 6.9% in 48 hours. And while your portfolio was bleeding, central banks quietly bought 47 more tons of gold in a single week. That is not speculation. The World Gold Council's latest Q1 report confirms it. Central bank purchases accelerated during the exact window that silver and gold prices collapsed. If you hold any physical silver or gold right now, what happened last week was not random, and the implications for your stack are enormous. By the end of this video, I am going to show you exactly who engineered this move, why they did it, and the one piece of data that reveals what comes next. But first, you need to understand what actually happened on April 3rd. Stop and think about this for a second. Retail investors panic sold over $800 million in silver ETFs last Thursday alone. On that same day, the People's Bank of China added to their gold reserves for the 17th consecutive month. Same asset class, opposite directions. Somebody is wrong about what these metals are actually worth, and I do not think it is the central banks. Here is the timeline nobody is putting together. On Wednesday, April 2nd, Jerome Powell delivered what looked like a routine press conference. He used one phrase that sent shockwaves through metals markets. He said the Fed sees no urgency to adjust rates. That is code. The algorithms decoded it instantly. Within 90 minutes, silver dropped 3.2%, gold fell 1.8%, the dollar index spiked, and leveraged longs got liquidated across the board. Now here is what makes this suspicious. The Fed knew exactly what that language would do. They have done this before. In June 2023, Powell used nearly identical phrasing and silver dropped 4% in a single session. In March 2024, same pattern, same result. What this means for you if you are holding silver right now is critical. These are not random sell-offs. They are engineered liquidity events designed to shake out weak hands and transfer metal from retail to institutions. But here is the part that nobody in financial media will tell you. While retail was dumping, someone was buying, and they were buying a lot. Ask yourself this question. If silver is genuinely crashing because fundamentals deteriorated, why did physical premiums at every major dealer actually increase during the sell-off? That makes zero sense, unless the paper price and the physical market are telling two completely different stories. Let me show you the 3 data points that expose what really happened. Number 1, central bank accumulation during the dip. According to the World Gold Council, central banks purchased 47 tons of gold in the first week of April alone. China, Poland, India, and Turkey were the largest buyers. China has now added to reserves for 17 straight months. Their total declared holdings sit at 2,300 tons, though analysts at Goldman Sachs estimate the real number could be double that. What this means for your position is straightforward. If the institutions that literally print currency are racing to exchange it for metal, the paper price is a lie. Think about that for a moment. The people who create money out of thin air are trading it for gold and silver as fast as they possibly can. That should terrify anyone holding only cash right now. Number 2, the short interest explosion. Open interest on silver futures spiked by 14% in the 3 days surrounding the sell-off. That means new short positions were opened before and during the price drop. Somebody was not just expecting this move, they were positioning for it weeks in advance. JPMorgan currently holds the largest concentrated short position in silver on the COMEX. According to the latest Commitment of Traders report, commercials added over 12,000 new short contracts in the reporting week ending April 1st. That is not hedging. That is a coordinated takedown. Here is what this means for your stack specifically. If you own 100 ounces of physical silver and the paper price dropped 6.9%, your portfolio value fell by roughly $203 on paper. But those short sellers need to eventually buy back every single one of those contracts. When they do, prices snap back violently. It is called a short squeeze, and silver has one of the most explosive histories of any commodity. Remember the silver squeeze of January 2021? Retail buying forced silver from $25 to $30 in a single week. This time, the setup is even more compressed because inventories are drastically lower. If you found this information valuable so far, hit the like button right now. It helps this video reach more stackers who need to see these numbers before it is too late. Number 3. The East versus West divergence. This is where the story gets really interesting. While Western paper markets were dumping silver and gold prices, something very different was happening across Asia. The Shanghai Gold Exchange reported a daily delivery volume of 18.4 tons on April 3rd. That is the highest single-day physical delivery since August 2024. Here is why that matters so much. Shanghai buyers are taking physical delivery of real metal. They are not trading paper contracts back and forth. They are removing gold and silver from the global system permanently, and they paid a premium to do it. The Shanghai gold premium over the London fix expanded to $11 per ounce during the sell-off. For silver, the premium widened to nearly $2 above international spot. Asian buyers looked at the exact same price drop and saw a buying opportunity, not a crisis. What this means for your holdings is profound. If you are holding physical silver right now, you are positioned on the same side of the trade as the People's Bank of China, the Reserve Bank of India, and institutional buyers across Southeast Asia. The paper price is a temporary distortion. The physical accumulation is permanent and accelerating. Let me put this differently. Wall Street says silver is falling apart. Shanghai says silver just went on sale. One of them is spending real money. The other is shuffling paper contracts. Who do you trust? Now here is where everything I have shown you connects together. Remember what I told you at the beginning? Central banks bought 47 tons, while retail sold 800 million in ETFs. That is not a coincidence. It is a playbook that has been running for decades. The Federal Reserve jawbones the dollar higher with hawkish language. Algorithms crash commodity prices on cue. Retail investors panic and sell at the bottom. And institutions on the other side of the trade scoop up physical metal at artificially discounted prices. This is not conspiracy theory. This is documented market mechanics. The Bank for International Settlements published a paper in 2022 acknowledging that central bank communication intentionally impacts commodity pricing cycles. And here is the hidden truth that nobody on mainstream financial media will say out loud. The Federal Reserve does not just influence gold and silver prices by accident. They need precious metals suppressed. Because rising gold prices are the single clearest signal that the dollar is losing purchasing power. Gold above $3,000 per ounce is a flashing red alarm that $34 trillion in national debt is becoming unsustainable. Silver at $30 is embarrassing enough. Silver at $50 or $100 would trigger a full-blown crisis of confidence in the entire dollar-denominated financial system. What this means for stackers is transformational. Every single crash is an accumulation event disguised as a disaster. The institutions understand this. Central banks understand this. The only people who do not understand are retail investors watching the ticker turn red and selling their positions at the worst possible moment. Now you might be thinking, if the Fed can suppress prices indefinitely, why bother stacking at all? Excellent question. And the answer is simple. They cannot keep doing this forever. Let me show you why. The COMEX registered silver inventory has dropped to 73.4 million ounces. That is down 38% from the 2023 peak. Every single time paper prices get engineered lower and physical buyers step in, more metal gets drained from Western vaults and shipped east. The vault is emptying. Now I want to tell you about something I have been using to manage positions during volatile moves like this one. WEEX is one of the fastest growing exchanges right now, offering up to 200 times leverage on silver and gold futures alongside crypto pairs. When the Fed engineers these sell-offs, WEEX lets you position both directions with tight spreads. If you want to trade the volatility that these institutions create, the link is in the description below. Use my code for a bonus on your first deposit. Subscribe and hit the bell notification if you want to see exactly when the next engineered sell-off happens. I track these patterns weekly so you can position before the move, not after. China, India, and the Gulf states are not just buying gold for portfolio diversification. They are actively constructing settlement systems that bypass the dollar entirely. The BRICS nations settled over $140 billion in non-dollar trade last quarter alone. Every ounce of gold they accumulate is another step toward de-dollarization. Here is the number that should keep Jerome Powell awake at night. China has imported over 2,000 tons of gold in the past 18 months. That is more than the entire COMEX registered inventory combined. They are not buying because they think prices will fall. They are buying because they know the suppression cannot last. The game is elegantly simple. The West suppresses paper prices. The East accumulates physical metal, and this continues until Western vaults run dry. When the music stops, whoever holds the physical wins. Paper becomes worthless. What does this mean? If you are sitting on a modest stack right now, it means every single ounce you hold is being repriced in real time by the actions of sovereign nations who are making massive bets against the dollar. You are not speculating. You are front-running the most telegraphed trade in monetary history. If you want daily breakdowns like this one delivered straight to your feed, subscribe right now and hit the bell notification so you never miss an alert when these institutional moves happen. So what does all of this mean specifically for your position? Let me break it down. For a 100-ounce silver stack at today's spot price of roughly $29 per ounce, you are looking at a current value of approximately $2,900. Conservative scenario. The Fed continues suppression cycles, but relentless physical demand keeps draining inventory. Silver grinds higher over 12 months to $38 per ounce. Your 100-ounce stack rises from $2,900 to $3,800. That is a 31% gain simply by holding through the noise. Bullish scenario. COMEX registered inventory falls below 50 million ounces, triggering a physical delivery squeeze. Silver spikes to $65 per ounce within 6 to 9 months, similar to the 2011 run that took silver from $18 to $49. Your 100-ounce stack jumps to $6,500. That is a 124% gain from today's artificially suppressed price. And here is what makes both scenarios so powerful. They both assume you did exactly what the central banks did. You bought during the engineered sell-off instead of panic selling. Drop your stack size in the comments right now. Whether you are holding 50 ounces, 100, or 500, I want to know how many of you are positioned for what comes next. Now remember what I promised you at the beginning of this video. I said I would reveal the one piece of data that shows what happens next. Here it is. The gold to silver ratio currently sits at 92 to 1. The historical average is 60 to 1. Every single time this ratio has spiked above 85. Silver has outperformed gold by at least 50% in the following 18 months. Every time, 2011, 2020, and now 2026. The Fed can engineer as many sell-offs as they want. Central banks will keep buying every single dip. Physical inventories will keep draining from Western vaults, and the ratio will keep compressing until silver reprices violently to the upside. Now you understand exactly what happened. This was not a crash. It was an engineered shakeout designed to transfer metal from weak hands to institutional vaults. The proof is in who was buying while everyone else was selling. 47 tons of proof. And once you see this pattern, you cannot unsee it. Every red day on the silver chart is a green day in a central bank vault somewhere in Asia. Check out this video next, where I break down the exact vault numbers that show how close we are to a physical delivery crisis. I will see you there.